Now let's look at what is the purpose of uh, creating. Organizations have money flowing in, money flowing out. So what is the purpose? So for that, let me first answer what you mean by accounts. The purpose of accounts, let me first understand what are accounts. Accounts very simply is a summary of all the financial data in a business. As I said before, money is flowing out of a business. Money flows in when sales happen, money flows out when you do a purchase of some goods. So that when those transactions happen, we need to have a situation where all these data is put together in a form that makes sense for us to understand what is the financial position from time to time. So what is this financial data? As I mentioned, financial data come from the actual transactions, or what are otherwise also called as economic events that happen in a business. These transactions can be sales of goods, purchase of goods, payment of expenses, payment of your loan, payment of interest, and so on and so forth. So as they happen, we need to have this financial data in a summarized form. But before that, I need to record. As the transactions are happening, I need to record at some place in the business what these transactions are, where they are happening, what the amount of these transactions are. Now, this is usually done in what are known as books of prime entry. But then this financial data is scattered in different places in different books. Now these all need to be brought into a centralized place, and that is where the so-called ledger accounts come into play. All these details, as we go along, we will see in much more depth and understand what the books of prime entry are, what the so-called ledger accounts mean, and how these work in a accounting environment. So to summarize, what it means is the summary is finally from here, the ledger accounts, it flows into a summarized form, which is what we said accounts are all about, in the form of what is known as balance sheet and profit and loss account. We will shortly see what these two mean, but they generally give you an idea of the financial status. Is the company making, or is the business making profit or not, and is the assets of the company more than its liabilities, or are the liabilities outweighing the assets of the company. So we will look at that shortly. Before I proceed on to the next part, to say, let's just look at two parts of accounting, which is financial accounting and management accounting. Now financial accounting is what I have been discussing with you till now. The accounting is not meant for purpose of to find out how I can efficiently run the company. It does not give me, for example, information as to how much does it cost me to make a ton of cement in a cement company, or it doesn't tell me what is the cost of processing cotton in a spinning company, what is the cost of spinning raw cotton into a spun yarn. For example, that kind of data it doesn't give. So it doesn't give me data which I can use for efficient running of the company. And the data that it gives me is also historical. That is, once the actual event or the transaction has happened, then I record that and then I summarize that. So that is the nature of information that I get from financial accounting. But I need a different type of information when I'm running a company. The management requires a different type of information. As I mentioned, it may want to know how much does it cost to make a particular product, how much does it cost, or a particular process, how much does it cost. Those kind of information can be got from the kind of reports that are prepared under what is known as management accounting. Management accounting, some of the information can be drawn from the past financial accounting data, but they can also be future looking, in the sense that once the sales and marketing people say that during the year I am going to sell so much of X product, then the managers who are responsible for production, responsible for procuring the raw material, they can also make their budget in terms of how they are going to schedule their production, how they are going to purchase the raw material for that production, how they are going to interact with the vendors who are going to supply the raw materials, what sort of thing. So this forward looking planning, which can be done through what is known as budgets, is again under the management accounting process, which essentially does not fall in the purview of financial accounting. To give you a little more insight, let's run through a video clip now.
Financial accounting is designed to help people outside of the business make decisions. The people outside of the business that we concentrate on are creditors and investors. Creditors lend money to the business. Investors invest money in the business. Investors are actually owners of the business. Other outside users are governments, customers, suppliers, and labor unions. Although financial accounting is designed to help people outside of the business make decisions, people inside the business use financial accounting as well. Financial accounting produces multi-purpose reports. Unlike managerial accounting, where the report is designed to meet the needs of the user, financial accounting produces one set of reports, and those reports are used by any individuals that want to use the financial statements. They're not customized for each individual user. Financial accounting also follows rules. The rules that we follow in the United States are referred to as GAAP. GAAP is Generally Accepted Accounting Principles. So now let's review and pull it all together. We learned that accounting is the language of business. We also learned that accounting includes people and processes. Accounting captures, summarizes, and reports information about a business. It helps people to make decisions, and it includes three major areas. Those three areas are tax accounting, managerial accounting, and finally, financial accounting. Let's practice some more. What area of accounting is based on the needs of the user? We know that there are three areas of accounting. There is financial accounting, managerial, and tax accounting. Financial accounting produces multi-purpose reports. Managerial accounting is based on the needs of the user, and tax accounting is prepared for the government to determine the amount of taxes that are owed. So the area of accounting that is based on the needs of the users is B, managerial accounting.